The markets are painting a complex picture right now, and sitting at the center of the canvas is SoFi Technologies Inc., currently trading at precisely 24.17 USD, down 0.74 points or 2.97% regarding its intraday movement today. That red number on your screen might trigger an immediate instinct to look away or panic, but that reaction is exactly what the institutional algorithms feed upon. To understand why a stock that has been such a darling of the 2025 rally is taking a breather today, we have to look past the surface-level expectation that fintech only goes up when interest rates stabilize. The reality is that we are witnessing a classic liquidity rotation, a moment where the market digests the massive gains of the last 12 months, gains that saw this stock rise from the single digits to the mid-20s, and decides whether the next leg is a sprint to $30 or a stumble back to $20. This tension between the expectation of perpetual momentum and the reality of technical resistance is where the real money is made, not in the blind chasing of green candles. When you look at the intraday charts today, the price action at 24.17 USD tells a story of exhaustion, but not necessarily defeat. The volume we are seeing in the opening hours suggests that this is not retail capitulation. Rather, it looks like profit-taking from the smart money that entered positions heavily back in early 2025. You have to remember, SoFi expectations were incredibly high coming into this week following the Q3 earnings beat and the rollout of their expanded crypto trading services. The general belief, the expectation, was that this news would essentially catapult the stock through the $27 resistance level without looking back. But the reality is often more mechanical. When a stock like SoFi, or even high flyers like Nvidia stock or Tesla stock, runs too hot too fast, the moving averages act like gravity. Today's 2.97% drop is the rubber band snapping back. It is the market forcing a reevaluation of the price-to-earnings multiple, asking investors if they are comfortable paying a premium for growth in a year where macroeconomic signals remain mixed. What is fascinating about today's movement is how it contrasts with the broader sector. While SoFi is down nearly 3%, we are seeing divergent behavior in competitors. Robinhood stock trading activity has surged, pushing their ticker higher, while legacy giants like Schwab Intelligent Portfolios and Fidelity Investments are seeing relatively flat performance. This decoupling is significant. It suggests that traders are not dumping fintech as a whole. They are specifically taking chips off the table with SoFi to perhaps rotate into lagging peers or simply to hedge against the volatility that comes with SoFi's new aggressive expansion into digital assets. Investors often group these names together, thinking that if they invest online with one, they are all the same. But the market is starting to differentiate between the pure-play volatility of a Robinhood app and the diversified, bank-chartered ambition of SoFi. The friction we are seeing at the 24.17 level is the market trying to decide if SoFi is still a growth stock, valued like a tech company, or if it should be valued more like a traditional bank now that its earnings are becoming consistent. Let's examine the catalyst that everyone is talking about but few are analyzing correctly: the recent full-scale launch of crypto trading for broad consumers under their national bank charter. The headline sounds fantastic. It is the expectation of becoming the AWS of fintech, finally merging with the Coinbase of banking. However, the reality of this move is heavy with execution risk. While it opens up a massive new revenue stream, it also invites the kind of regulatory scrutiny that typically suppresses stock multiples in the short term. The drop to 24.17 USD today could be the market pricing in this regulatory overhang. Unlike dealing with a private wallet or a decentralized exchange, when you conduct crypto transactions through a platform that is as regulated as SoFi, the compliance costs are astronomical. The bears are betting that these costs will eat into the margins that the bulls are celebrating. This tug-of-war between the revenue potential of crypto and the cost of compliance is the invisible hand pushing the stock down today. Furthermore, we need to discuss the institutional flows that are shaping this chart. Recent 13F filings and institutional activity reports have shown a fascinating trend. while retail investors are aggressively buying the dip, using their Fidelity mobile app or SoFi active investing accounts to grab shares every time it drops below $25, the institutions are playing a different game. We have seen heavyweights like JP Morgan increase their stake, which is a massive vote of confidence. But we also see high-frequency trading firms increasing their short volume. This creates a volatile churn. When you see the price stuck at 24.17 USD, it represents a battlefield where long-term accumulators are absorbing the selling pressure from short-term arbitrage funds. This is not a stock in freefall, it is a stock in transfer. It is moving from the hands of weak-willed momentum chasers to the balance sheets of patient capital that sees the multi-year vision. This brings us to the core business model, which is often misunderstood by those who only casually browse investing sites looking for the next hot ticker. SoFi is not just a bank, and it is not just a tech platform. It is a vertically integrated financial ecosystem. The bear case has always been that they are too exposed to personal loans and student debt. The bull case has been that their technology platform Galileo makes them indispensable to other fintechs. The reality that is emerging in late 2025 is that the synergy between these two sides is finally working. The financial super app strategy is lowering their customer acquisition costs significantly compared to a standalone Robinhood investments account or a traditional interactive broker's account. When a user joins for a high-yield savings account and then refinances a loan and then starts trading options, the lifetime value of that customer explodes. The market is currently struggling to value this cross-selling efficiency. Is it worth a 50x multiple or a 15x multiple? The slide to 24.17 USD is the market saying, show us the sustainability of this cross-sell before we push you to 30. Comparing this to the broader landscape of self-investing and online investment platforms helps frame the valuation. If you look at Apple stock, they have made moves into finance with savings and lending, but they move slowly. SoFi moves with the speed of a startup, but now has the balance sheet of a legitimate bank. This agility is their greatest asset and their greatest liability. It leads to volatile days like today. Users who utilize Schwab Intelligent portfolios are used to slow, steady compounding. SoFi investors are used to 50% drawdowns and 100% rallies. This psychological profile of the shareholder base actually contributes to the volatility. Because the stock attracts aggressive growth investors, they are quicker to hit the sell button at the first sign of trouble, exacerbating moves like the minus 2.97% we are seeing today. It creates a self-fulfilling prophecy of volatility that has nothing to do with the fundamental health of the company. Now consider the macroeconomic backdrop. We are navigating an environment where interest rates have stabilized but remain higher than the free money era of the early 2020s. For a bank like SoFi, this is actually the Goldilocks zone. They earn excellent yield on their loans, but the rates aren't so high that defaults are spiking out of control. The fear, the expectation that causes drops like today, is that the consumer is cracking. You hear pundits on TV talking about credit card delinquencies rising. Since SoFi targets a higher income demographic, the Henry, high earner, not rich yet, their loan book is remarkably resilient compared to a subprime lender. The market, in its panic, often throws the baby out with the bathwater, selling off SoFi because a completely unrelated lender reported bad earnings. Smart investors, the ones who treat their individual brokerage accounts like professional portfolios, recognize this disconnect. They see that the credit quality of a SoFi member is vastly superior to the average borrower, making today's discount a potential inefficiency in the market. We also need to talk about the tech platform, Galileo and Technisys. This is the part of the business that competes more with infrastructure plays than with Fidelity Wealth Management. In a world where every company wants to launch their own debit card or loyalty finance program, SoFi provides the plumbing. This B2B revenue stream is less volatile than the trading revenue that fluctuates with the stock market. However, it is also lumpy. Large contracts take time to sign. The lack of a major new enterprise partnership announcement in the last few weeks might be contributing to the boredom we are seeing on the chart. Investors want constant news, constant dopamine. When they don't get it, they drift away. But business is built in the quiet periods. The integration of their banking core with their tech platform is a multi-year project that is nearing maturity. Once fully optimized, it allows them to launch products faster than any legacy competitor like interactive brokers trading platforms or standard banks. Let's take a moment to gauge sentiment. Comment below how many shares of SoFi you currently hold and what your average buy price is. Are you in the green from the single digits, or are you averaging down? Engaging with the community helps us see if retail sentiment is fearful or greedy right now. Moving back to the analysis, we have to consider the competitive pressure from the giants. Fidelity and Schwab are not sleeping. They have slashed fees, improved their mobile app, and offer massive enticements for new capital. Fidelity ETFs and Fidelity mutual funds are products that sticky money loves.